Today we're going to explain various sources of loans in money and credit chapter. People can obtain loans from various sources. The various types of loans can be conveniently grouped as formal sector loans, which include banks and cooperative societies or cooperative banks. Number two, informal sector loans, which includes moneylenders, traders, employers, relatives, and friends. In this graph, we can see the various sources of credit to rural household in India. So let us see which sector contributes how much credit to the rural sector in 2012, and that is estimated at rupees 1000 credit. Sources of credit per 1000 of rural households in India in 2012. Government sector provides 1%. Other non-institutional agencies provide 2%. Relatives and friends provide 8%. Landlord provide 1% credit. Other institutional agencies provide 5%. Money lenders provide 33%. Commercial banks 25% and cooperative banks 25%. Now, if we see this, then which sector provides more credit? Now, let us see the formal sector. Formal sector comes government, that is 1%. Then other institutional agencies 5%. Commercial bank 25% and cooperative banks 25%. So 25, 25, 50 and 5, 55. Other institutional 5, 55 and government 1%, 56%. So 56% of credit that is provided by the formal sector, and remaining 44% credit comes from informal sector. So formal sector is dominating in providing credit to rural sector. Now let us see the difference between formal sector loans and informal sector loans. Formal sector loans rate of interest charge is
High rate of interest is charged. Next, collateral is must for getting loan from a formal sector. Security. Collateral is the security which is must to get loan from formal sector. But in case of informal sector, there is no need of collateral. RBI supervises formal sector, but there is no organization to supervise informal sector. Rich urban households depend on formal sector loans. So the rich urban households, they usually take loan from formal sector, whereas poor households depend on informal sector. Formal sector loans example who provide the formal sector loans: banks and cooperative banks. Informal money lenders, traders, friends and relatives, they provide credit to the poor households under informal sector.
Organized banking sector is systematic in its functioning under formal loans. Formal loans given in under a systematic way. There is a process, formal process of giving loan. But in case of informal sector, this is unorganized sector. This is not so systematic and often indulges in malpractices to exploit the customers. Next, organized financial intermediaries maintain proper books of accounts. Their books of accounts are regularly audited. Their functioning is more transparent. Whereas unorganized financial intermediaries do not maintain proper books of accounts. They do not charge uniform interest rates. They keep their business affairs confidential. They can charge any rate of interest to any customer. Formal credit sector usually grants loan for productive purposes like purchase of machinery, agricultural implements, equipments, house, etc. Informal credit sector usually does not differentiate between loan for productive and unproductive purposes. They easily give loan even for unproductive purpose like loan for family function, for illness and for any other purposes, etc. In informal sector, documentation is required and it involves many formalities. But in informal sector, less documentation and less formalities required. That is why illiterate persons prefer to take loan from this sector. Need for banks and cooperative loan in rural areas. Formal sector charges low rate of interest. And that is why banks and cooperative loans are encouraged. Lack of formal sources of credit in villages. The formal credit sources are very less in rural areas. So this should be encouraged. More formal sources of credit such as bank cooperatives must be established in village areas, in rural areas. Villagers mainly depend on informal sector. Since there is no formal sources of credit, so most of the villagers depend on informal sector credit. Informal sector credits charge very high rate of interest and the farmers are being deceived. Borrowers come under debt trap. We have seen that the informal sources of credit is cursed to the people, those who take credit and they under the debt trap. Therefore, there is a need to expand formal sector so that everyone receives these loans. How does RBI supervise banks? RBI requires commercial banks to keep a certain percentage of deposits in cash and other in liquid assets. This percentage is called statutory liquidity ratio. So, Every bank out of a deposit, certain percentage of deposit they require to give in cash, and the remaining amount they can give to others as loan. RBI also requires commercial banks to deposit a certain percentage of their deposits with RBI in cash. The previous one with the commercial banks, it is retained by the commercial banks, but in this case, the money is retained by the RBI. This percentage is called cash reserve ratio or legal reserve ratio. RBI issues guidelines for fixing rate of interest on borrowings and lending by commercial banks. RBI fixes the guidelines for rate of interest. RBI directs the commercial banks to give a certain percentage of loans to top priority sector such as agriculture development. First, for agriculture development loans will be given. Next, maybe on the priorities industrial. So, after that, industrial sector will be given. And then maybe the personal asset to buy personal asset or to other things. In this way, the priority is given by the RBI, and according to that, the commercial banks provide credit. Why is credit a crucial element in the economic development? Credit provides resources for industries to create more factories and produce more output. It leads to lower cost of production and higher income. Credit provides more resources for farmers to invest in agriculture and produce more agricultural output. Credit enables entrepreneurs who may not have enough resources to borrow cheaply and set up new enterprises. This creates more jobs in economy and promotes development. So, to create employment opportunities, credit is essential. Cheap credit is a great poverty alleviation measure. It enables the poor to borrow cheaply from banks and escape the clutches of moneylenders. The poor can then benefit by setting up small businesses, which helps them to improve their living standards. So, the credit is needed. Cheap credit can help the poor to escape the debt trap, which they fall into when they borrow from moneylenders at high rates of interest. So, cheap credit is helpful to the poor farmers, those who are caught debt trap, and therefore credit is crucial element in the economic development. Thank you.